On the back of the BOC announcement that they're holding interest rates steady, the bond yields are dipping, and they're dipping fast. What could this possibly mean for interest rates over the next couple of months? And more specifically, what should you do when it comes to your mortgage terms? That's what we're gonna break into today with myself and of course, Chewy, the mortgage pug. So stay tuned. So here's the thing. The Canadian bond yields have been dipping for the better part of about 3 weeks. But interestingly enough, most major banks have been reluctant to reduce their advertised interest rates for quite some time. And there's a lot of reasons for that. Whether it be capital reserves, which is basically the money which they must be holding in case of emergency, in case of breaking glass, whether it be because they're paying too much money in GICs, whether it be because of trying to make up the profit of a very, very slow year. There's a lot of reasons, but the banks and lenders for the most part have been very reluctant to reduce interest rates up until recently, which we've started to see all the major lenders, including a lot of the non-bank lenders, really start to make a play in the interest rate game. Now, what's interesting is we've seen more interest rate reductions in the non-bank and insured space than the uninsured space. But before I explain exactly what rates are, let's talk really quickly. An insured mortgage is one that's insured backed by one of the three major insurers, CMHC, Sagan, or Canada Guarantee in the country. And of course, that typically means a purchase of a property with less than 20% down, under $1 million as a primary residence. For these types of mortgages, you're seeing most lenders go really hot and heavy and start to reduce their interest rates. In fact, we've just recently seen the first major non-bank lender reduce their interest rates to under 5% for a mortgage term of at least 1 year. More on that later. With that being said, that space is starting to heat back up. Where we're also seeing interest rates start to reduce is the 5-year term range. And that's really where the banks are trying to drive most of their business right now. One of the big reasons for that is because, well, we all know that interest rates are likely to come down over the course of the next 12 to 24 months. So they're trying to fill up their 5-year buckets as quick as they can, while most consumers continue to look for 3-year terms. Why are people still taking these mortgage terms? Typically comes down to what we call the minimum qualifying rate, which is basically meaning some people actually have to take these long terms with these lower interest rates just to be able to qualify at a stress test of over 7%. Now, we don't suggest that people do that. In fact, we'd almost suggest you better to wait things out before going ahead and taking a 5-year commitment. And while we've seen most of the banks push the 5 years, we are starting to see minimal dips in the 4-year and the 3-year uninsured and insured space. Now, this is a great sign for those, again, looking to see a housing market rebound. For so many people, they're calling for the death of the Canadian housing market, showing collapses. There's all the naysayers on X and TikTok and everything else beating up on house prices. And there's no doubt we're down from the highs of 2021, 2022. But this could signal a bottom in house prices, a bottom in terms of the ability to qualify. And if it means that interest rates are going down, and if predictions are correct, not only will people qualify for more, but we will start to see house prices start to rebound in some areas throughout the country. Now, there could be certain areas that we see house prices rebound quicker than other places, but overall, I do believe that this will impact the market from a positive perspective. And as we head into spring, we'll start to see a lot more activity as demand still remains relatively high. Now, continuing on interest rates right now, most of the economists are predicting that we're going to hit a 2% inflation rate by 2024, which essentially says that we're going to start seeing rate cuts as early as April in 2024. And most economists are basically baking it in that that's a guarantee. Now, Benjamin Tal came out recently and he said his predictions are that interest rates are going to come down 1.5% over the course of 2024. Remember this, for every 1% reduction in interest rates, we see an 8% increase in borrowing power. And so if we see interest rates go down 1.5%, that's a 12% increase in purchasing power. That's not insignificant, and that marks a major potential increase in house prices. Now, a couple things to note is that we think that there will be an increase in house prices primarily in the detached housing market first, for a lot of reasons, one of which that is the desirable purchase price for a lot of families, and those that are thinking about making the move up typically do so in the spring market. For that reason alone, we think that detached house prices are getting close to, if not in their bottom, for a lot of major markets across the country. Now, we know this won't be just a smooth increase back up, because we also have to deal with a lot of unemployment issues, and of course, just generally speaking, the cost of living is going to start catching up to people, because typically the interest rate increases that have happened typically take 6 to 12 and sometimes 18 months to work their way through the economy. So it's not going to be a smooth rocket ship back up, but we do believe it will be near the bottom for a lot of places. Now, speaking of interest rates, another reason that the major banks are not just dropping their interest rates is because they're concerned about potential credit losses, whether that because people are writing off credit cards, lines of credit, or in the case of the very few people who are writing off mortgages, they're going to keep their rates higher to, of course, make sure to cover for any of those potential losses. But you best believe come the spring market, assuming things continue on this trajectory, they will start to come back down again. again. Now, a smart person considers some different alternatives in this type of a market, whether it be 1% reduction or 1.5% reduction in 2024. The favorable route right now is to consider an ARM product, which is an adjustable rate mortgage. Most major banks, as you can recall, don't actually have that product. They have the fixed payment. With an adjustable rate mortgage product, you'll actually see your payments decline or decrease as rates come down. Now, a lot of people are still opting for mortgage terms along the 2-year and 3-year mark, the 3-year being the most common Canadian mortgage that's taken right now today. We still think that's a good play for someone who is conservative, who's a little bit concerned about where the market's going or needs that stability. But if the option presented itself for someone who is well capitalized, we suggest considering that adjustable rate mortgage today, and it could be a great option and a great play if things pay off. Now, overall, where are house prices going, where are rates going? We know a couple of things. One, typically rates go up, house prices go down. 2, rates go down, house prices go up. There's a lot of naysayers, as we suggested, out there, but the one thing that they're not fixing quickly enough is the supply issue. And while demand remains absolutely through the roof, with so many people still continuing to come to our country, we do not think that building a number of condos is really going to fix this issue, because we have condos all over across the country, and a lot of families that have 2, 3, 4, 5 kids in some cases cannot live in a 1-bed or a 2-bed condo. And so for that reason, if no other reason, we do believe that that townhome, that detached housing market is going to bounce back, and we are going to see house prices continue up in the next couple of months. But I'd love to hear your predictions. What are you suggesting for house prices over the next little while, and what would you like to see?